Imagine this, $4.2 trillion. Just gone. That's roughly the wealth that vanished from consumers' pockets during the U.S. financial meltdown that really hit its peak around 2008.
Yeah, or picture Lehman Brothers, a giant investment bank just collapsing, filing for the biggest bankruptcy ever in the U.S.
And Washington Mutual.
Yeah.
The biggest bank failure. It wasn't just like a bad day on the stock market. This was something deep, complex, and global.
Absolutely. It wormed its way into everything, homes, businesses, banks all over the world, and figuring out why it all happened, that's just crucial if we want to avoid repeating it.
Exactly. So welcome to the Deep Dive. Today we're tackling U.S. market crash, lessons from the 2008 financial crisis. We've gathered, all sorts of sources, academic studies, government reports, historical takes, investment analysis.
Trying to piece together not just the what, but the why, and importantly, the so what. What are the real lessons you can take away?
Our goal here is pretty straightforward. Unpack the causes, trace the fallout, look at the response, and pull out those key learnings. It's about equipping you with a clearer lens to see finance and investing.
So let's dig in. How did this storm even start brewing?
Right. Section 1, the perfect storm. First things first, what do we even mean by crisis in this financial sense? It's not just things going bad, is it?
No, not exactly. Economists often see it as the end stage of a bigger threat process. You have tension, then challenges, warning signs pop up, risk builds, and then you hit the crisis point.
Like the culmination.
Precisely. It's when the potential danger becomes real, immediate. And crucially, crises usually force big structural changes. But here's the catch.
What's that?
If you only treat the symptom, patch things up, but ignore the deep root causes, well, you're pretty much asking for it to pop up again later, maybe in a different form.
That makes sense. Fix the foundation, not just the cracks in the wall. And with 2008, our sources often talk about it having two parts.
That's a really helpful distinction, yeah. You usually get the financial crisis first. That's the banks failing, markets freezing, asset values just plummeting, pure financial chaos.
Okay.
And then, often triggered by that financial mess, comes the real economic crisis. That's when it hits, Main Street businesses contract, people lose jobs, homes get foreclosed on, real hardship for everyday people. 2008 definitely had both. The financial meltdown dragged the whole real economy down with it.
And at the absolute core of that initial financial crisis, the housing market, ground zero.
Absolutely. And it's eye-opening to look back. Robert Shiller, the economist, he has this famous data.
Right, on long-term housing prices.
Exactly. He showed that if you put $100 into U.S. housing back in 1950, adjusted for inflation, it was worth only about $104 by 1997.
Wow. So basically just keeping pace with inflation, not much more.
For almost half a century, yeah. Housing was mostly shelter, not this engine for getting rich quick.
So this whole idea of house prices always booming is actually pretty recent.
Relatively speaking, yes. And the mid-2000s, that was an extreme break from the past. Historically, a house might cost, say, 20 times its annual rent.
Okay, a rule of thumb.
Kind of. So if a place rented for $830 a month, maybe $10,000 a year, it'd typically sell for around $200,000. That was the norm for a long time.
But leading up to 2008.
It went completely off the rails. By 2005, 2006, prices hit a peak of around 32 times annual rent.
32 times.
Yeah. So that same house renting for $830 a month, suddenly selling for $320,000, way above that historical $200,000 mark. There's a chart, figure 7 in the sources, that just shows this price to rent ratio going almost vertical. Prices totally detached from underlying value.
Pure speculation territory.
Absolutely. It wasn't about fundamentals anymore.
And what was driving that? The sources seemed clear. Financial institutions chasing profit.
Oh, definitely. They saw prices climbing and thought, we need a piece of that. Housing looked like a gold mine, but to keep the machine going, they needed more buyers.
Which meant making it easier to get a mortgage.
Exactly. And that leads us to a really key change. Down payments just plummeted. There's a table 1 that shows this.
What did it find?
Well, back in 1989, the median down payment for everyone buying a house was 20%. Pretty standard.
Right.
By 2007, right before the crash, it was down to 9%. And for first-time buyers, it went from 10% in 89 down to just 2% in 2007.
2% down. That's almost nothing. Seems incredibly risky for the bank.
It was. It showed lenders were taking on way more risk, needing much less skin in the game from the borrower. Why? Because everyone assumed prices would just keep rising forever. That future appreciation was supposed to cover the risk.
So we've got soaring prices, detached from reality, and lenders basically throwing open the doors with tiny down payments. This feeds right into the next part. The amplifier. Leverage and risky lending. Leverage was huge here.
Huge. Leverage is just, using borrowed money to try and boost your returns, like using a credit card to buy stocks, basically. Banks always use leverage. They lend out much more than they hold in deposits. A typical bank might be, say, 11-to-1. Borrow $11 for every $1 of their own money.
But the investment banks,
they took it to another level. Lehman Brothers, for example, was reportedly leveraged 30-to-1, maybe even more at times.
$30 borrowed for every $1 of their own.
Yeah.
Wow.
It turbocharged profits when things were good. But homeowners were using leverage too, remember? That 2% down payment.
Yeah.
That's 50-to-1 leverage. You put down $2, you borrow $98 to buy a $100 asset.
So if your $100,000 house goes up 10%, you've made $10,000 on just $2,000 down. Doubled your money. Sounds amazing in a boom.
It did. Some people saw their initial investment double or triple on paper every year. But like you said earlier, it's a double-edged sword.
Right.
Magnifies gains, yes, but it magnifies losses even more brutally. If that $100,000 house price drops just 3%, your $2,000 is completely wiped out. Gone.
Ouch. So massive risk for the homeowner and for whoever held that mortgage.
Exactly. And this acceptance of risk ties into those lax lending standards everyone talks about.
What did that look like specifically?
Well, beyond the tiny down payments, loans were often structured to look cheap up front. Low teaser interest rates that would suddenly jump after a couple of years, adjustable rate mortgages, or
ARMs setting people up for payment shock down the road.
right. And even interest-only loans where you weren't paying back any of the actual loan principal for years. It made expensive houses seem affordable temporarily.
And things got particularly bad in the subprime market, didn't they? Lending to borrowers with weaker credit histories.
Oh, yeah. Standards just eroded. Historically, subprime might mean a FICO score below 660 or so. By 2005, lenders were often going down to 620.
Okay.
But even more significant, perhaps, was the documentation. It went from needing full proof of income and assets to low-doc loans, and then infamously no-doc loans.
The N9J loans. No income, no job, no assets. Seriously.
Seriously. They were often called liar loans because, well, there wasn't much verification happening. The assumption was rising house prices would cover any problems.
Just keep appreciating.
Exactly. We even have whistleblower testimony on this. Richard Bowen at Citigroup, he was an underwriter.
What did he say?
He testified that by 2006, his unit found that 60% of the mortgages Citi was buying from other lenders were defective. They didn't meet Citi's own standards, even though the sellers certified they did.
60% defective. That's not just a few bad loans.
Not at all, and he said it got worse. By 2007, it was over 80%. 80% defective. It points to a systemic breakdown in quality control. The very institutions packaging these things knew they were often flawed.
So you've got this flood of risky loans fueled by easy money and leverage pouring into a housing market that's already bubbly. How did this mess get packaged up and spread around the globe? That brings us to the financial alchemy, securitization and derivatives.
This is where things get really complex and, frankly, where the risk got hidden and multiplied. Securitization, that's the process of taking thousands of individual mortgages, pooling them together, and then creating new investments, new securities, backed by the payments flowing from those mortgages. These are mortgage-backed securities, or MBS.
So the bank that originally made the loan could just sell it off into this pool.
Exactly, and that's a huge point. Once they could sell the loan, their main incentive wasn't necessarily the quality of the loan anymore. It shifted.
So just making more loans.
Right. Originate as many as possible, collect the fees, and pass the risk on to whoever bought the MBS. This structure basically encouraged those lax lending standards we talked about. And to make these MBS seem safer, they were often insured using credit default swaps, CDS, which we'll get to.
But it didn't stop with MBS, did it? Then came CDOs.
Correct. Collateralized debt obligations, another layer of complexity on top. CDOs took slices of these MBS pools and other debt and repackaged them into new securities with different levels of risk called tranches.
Slicing and dicing the risk.
Supposedly. Some tranches were rated AAA, super safe, even if they were backed by those questionable subprime MBS. Investors all over the world weren't just buying U.S. houses. They were buying these MBS and CDOs, investing indirectly in the U.S. housing market.
And the derivatives, like those credit default swaps, the CDS, they started as insurance, right?
Originally, yes.
Yeah.
If you owned a bond, you could buy a CDS from someone who promised to pay you if that bond defaulted. like insurance.
They morphed into something else.
Completely. They became speculative tools. You could buy or sell CDS on debt you didn't even own. Essentially, you were just placing bets on whether a company or even these pools of mortgages would fail.
Like betting on someone else's house burning down, even if you don't own it, or the insurance policy.
Kind of, yeah. And the market for these things absolutely exploded.
How big are we talking?
The estimated value of the over-the-counter derivatives market where most CDS traded grew 100-fold between 1998 and 2008. By mid-2008, the total notional value was estimated at something like $683 trillion.
Trillion, with a T.
With a T. It's why Warren Buffett famously called derivatives financial weapons of mass destruction way back in 2003. They were complex, opaque, unregulated, and connected financial institutions in ways nobody fully understood.
So this whole process, securitization, CDOs, CDS,
Yeah.
it took simple home loans and spun them into this incredibly complex, tangled web. The distance between the investor and the actual house, the actual borrower, grew enormous.
Exactly. And
Yeah.
because of that distance and complexity, everyone started relying on shortcuts. FICO scores, automated home appraisals, and critically, the ratings from the credit rating agencies. They became proxies for real understanding.
And when those proxies failed.
The whole system was vulnerable. And a lot of this high-stakes action wasn't happening in your regular, highly regulated banks, was it? It was in the shadow banking system.
Right. What exactly is that?
Think investment banks, hedge funds, money market funds, entities that perform bank-like functions like credit creation, but aren't subject to the same strict rules as traditional depository banks, especially around holding capital reserves or having deposit insurance.
And they grew massively during this period.
Hugely. They took on enormous amounts of debt, driving this whole securitization machine, but without the safety buffers of traditional banks.
Timothy Gaithner, who was head of the New York Fed then, pointed out a specific danger there.
Yeah, he highlighted their funding mismatch. They were borrowing money short-term, sometimes even overnight in very liquid markets, but they were using that short-term money to buy long-term illiquid assets like those complex MBS and CDOs that were hard to sell quickly.
So borrowing daily to buy something you might not be able to sell for months or years.
Exactly. Profitable when money is flowing freely, but incredibly fragile. If their short-term lenders got nervous and suddenly stopped lending, basically, a run on the shadow banks, they'd be forced to sell those illiquid assets immediately.
At fire sale prices, driving values down further.
Which is exactly what happened. It created a vicious cycle and was a major reason credit markets completely froze. These shadow banks were crucial for lending, and they just seized up.
And regular banks weren't entirely transparent either, using things like SIVs.
Right, structured investment vehicles. These were off-balance sheet entities. Some big banks, like Citigroup, used to hold these risky assets and the associated debt.
Hiding the true extent of their risk and leverage.
Effectively, yes. It made it even harder for regulators, investors, even the banks themselves sometimes to see the full picture of vulnerability, just added more uncertainty.
And all this happened alongside some specific regulatory failures, didn't it?
Oh, absolutely. In 2004, the SEC actually relaxed capital rules for the big investment banks, letting them take on even more debt, increasing their leverage.
Just when they probably needed tighter rules.
You could argue that, yeah. And maybe the biggest gap was the lack of regulation for that huge over-the-counter derivatives market, especially CDS. The Commodity Futures Modernization Act of 2000 basically walled it off from federal oversight, a massive blind spot.
Beyond the structures and rules, the sources also point to just plain questionable practices and conflicts of interest.
For sure. Predatory lending wasn't just about low standards. It was sometimes actively targeting vulnerable borrowers with deceptive, unaffordable loans. And this arguably got worse after 2004 when federal rules overrode some tougher state-level anti-predatory laws.
Allowing weaker standards to prevail.
Essentially. Lawsuits against lenders like Countrywide Financial brought a lot of this to light.
And the credit rating agencies, you mentioned their incentives.
Big conflict of interest there. They were paid by the companies creating the complex securities like MBS and CDOs to rate them.
The issuer pays model.
Right. And they handed out AAA ratings, the highest, safest rating, like candy to structures built on pools of risky subprime mortgages. Were they just meeting demand from this giant pool of money searching for yield, as some argue? Or was it a fundamental failure to assess risk? Probably a bit of both, but the result was disastrously misleading ratings.
Government policies also get mentioned, sometimes controversially, encouraging homeownership.
Yes, policies aimed at making homeownership more accessible certainly increased demand for housing and loans, which added fuel to the price boom. There is a specific debate around the Community Reinvestment Act, the CRA.
What's the argument there?
Some critics claim the CRA forced banks to make risky loans to lower-income borrowers, contributing to the subprime problem.
But the research.
Fed economists looked into it and found, well, actually only a small fraction of subprime loans seemed directly linked to CRA requirements. And those loans didn't perform significantly worse than other subprime loans. So their conclusion was the CRA wasn't a major driver of the crisis itself.
Okay, so the data pushes back on that idea. But the critics still have counter-arguments.
Yeah, some argue the Fed's analysis might miss the bigger picture, like the timing with low interest rates after 9/11, and the huge dollar commitments banks made under CRA agreements, $4.5 trillion cited between 94 and 07. They also sometimes question how loans were classified in the studies. It's one of those areas where interpretations differ, but it's part of the mix when discussing factors that influence the lending environment.
Another government-linked element was Fannie Mae and Freddie Mac.
Huge players. These government-sponsored enterprises, GSEs, buy mortgages, package them, guarantee them. They're massive. And because everyone assumed the government would bail them out if they failed an implicit guarantee.
That created moral hazard.
Exactly. They had less incentive to be cautious because they expected a safety net. They ended up buying and guaranteeing vast amounts of risky mortgages, including subprime securities, feeding the beast. And sources note the Bush administration actually warned about GSE risks back in 2003, but yeah, those warnings weren't really acted upon.
And finally, inside the firms themselves, the way people got paid.
Big issue. Compensation was often tied to short-term results. Close the deal, sell the security, get your bonus now. There wasn't enough focus on the long-term risk or quality of what was being sold. It incentivized volume and speed over prudence.
So it really was a perfect storm, not one cause, but all these things interacting. The housing bubble, easy money, leverage, bad lending, complex and opaque finance, shadow banking, regulatory gaps, dodgy practices, misaligned incentives.
A fragile system just waiting for a trigger.
And that trigger was falling house prices. Which brings us to Section 2, the breaking point and global fallout. When the music stopped, what happened?
Well, Section 2.1 calls it the bubble bursts. Once prices started falling, that whole logic based on ever-increasing values just collapsed.
Because suddenly, all those people with tiny down payments owed more on their mortgage than the house was actually worth. They were underwater.
Precisely. And when you're deeply underwater, suddenly foreclosure doesn't look so bad financially. For many, it became the rational choice, sadly, just to walk away. Foreclosures skyrocketed and stayed high for years, right into 2014.
And as house prices fell, what happened to all those MBS and CDOs built on them?
Their value just evaporated, plummeted. Huge losses started appearing on the books of banks and investors everywhere. And worse, the market for them just froze. Nobody wanted to buy them at any price because nobody knew what they were truly worth or how bad the underlying loans were.
So institutions holding them were stuck.
Yeah.
Liquidity dried up.
Exactly. A massive liquidity crisis hit. They had assets they couldn't sell and couldn't borrow against.
And the impact on ordinary people. Beyond foreclosures.
Devastating. That $4.2 trillion wealth loss figure we started with, that was falling home equity, retirement accounts crashing with the stock market. And as the financial system seized up, it choked off credit to the rest of the economy. Defaults on car loans, credit cards, business loans, they all started rising too.
Which led pretty quickly to major institutional failures in the contagion.
Yeah.
We saw warning signs early, right?
Yeah, there were tremors. Northern Rock in the UK had a bank run. Countrywide, the U.S. mortgage giant needed rescuing. By 2007, 2008, over 100 smaller mortgage lenders had already gone bankrupt. But the real earthquake hit in September and October 2008.
That infamous period. What were the key events?
It was just one after another. Bear Stearns, a big investment bank, had already been forced into a fire sale to J.P. Morgan Chase back in March.
Okay.
Then September 7th, the government seized Fannie Mae and Freddie Mac, massive intervention.
Right.
September 15th, Lehman Brothers files for bankruptcy. That sent shockwaves everywhere. People realized maybe no one was too big to fail.
The largest bankruptcy in U.S. history at that point.
Yep. The very next day, September 16th, AIG, the world's biggest insurer, deeply entangled through CDS, needed a colossal $85 billion government bailout to stop it dragging down the entire system.
Just kept coming.
It did. September 25th, Washington Mutual, a huge savings and loan, collapsed, seized by regulators, biggest U.S. bank failure ever. Wachovia was forced into a sale. Citigroup needed help. It was a full-blown meltdown.
Richard Fuld, Lehman's CEO, later blamed a crisis of confidence.
Yeah.
Is that fair?
It definitely captures a key element. Finance fundamentally runs on trust. When nobody trusted anybody else, didn't know who was holding toxic assets, who might fail next, lending between banks just stopped, markets froze. Confidence evaporated, and the dominoes fell.
And this wasn't just a U.S. problem. Section 2.3 talks about the crisis goes global. How did it spread?
Several ways. First, the U.S. economy was and is huge. U.S. consumers had been driving a lot of global growth, like over a third of consumption growth between 2000 and 2007. When the U.S. consumer slammed on the brakes, the world felt it.
But it was also more direct, wasn't it? Those toxic assets.
Weren't just held by U.S. banks. Oh, no. European banks, Asian funds, investors everywhere had bought into the U.S. housing boom via MBS and CDOs. They were suddenly holding trillions in assets that were now worth far less or were untradeable.
And the derivatives, the CDS, linked everyone together.
In incredibly complex, often unseen ways, a failure in one part of the system could trigger payouts and losses far away, cascading through these connections.
So when U.S. institutions started failing or desperately selling assets,
it forced a global fire sale. Everyone needed cash. Everyone was trying to reduce risk, deleverage at the same time. Selling assets into a falling market just drove prices down further. Credit markets froze globally. International trade plummeted because financing dried up and demand collapsed.
and this wasn't just hitting rich countries. Developing nations felt it too.
Absolutely. The sources show examples like Armenia. They saw trade fall, commodity prices collapse, hurting their exports, foreign investment dry up, even money sent home from workers abroad decreased. All these things pushed poverty rates up in many developing countries. It was a brutal lesson in global financial interconnectedness.
So a global crisis demanding a huge response. That takes us to Section 3. Responding to the unprecedented, or was it? What did governments and central banks actually do?
Section 3.1 gives the overview, basically massive interventions across the board, bailouts, monetary stimulus, fiscal stimulus deployed worldwide to try and stop the bleeding and stabilize things.
What were the key U.S. actions?
Well, legislatively, you had the Housing and Economic Recovery Act in 2008. That's what allowed the government takeover of Fannie and Freddie.
Okay.
Then the big one, the Emergency Economic Stabilization Act, usually called TARP, Troubled Asset Relief Program. That authorized the Treasury to spend $700 billion, mostly to buy toxic assets off banks' books or inject capital directly by buying bank shares, trying to shore them up.
And the Federal Reserve.
The Fed went into overdrive. They launched quantitative easing, QE, buying huge amounts of treasury bonds, and, crucially, those mortgage-backed securities to inject cash into the system and push down long-term interest rates.
They're trying to get money flowing again.
Exactly. And then in early 2009, Congress passed the American Recovery and Reinvestment Act, a big stimulus package, government spending, tax cuts, trying to boost the real economy and create jobs.
The Fed also set up specific programs for the frozen credit markets, didn't they?
Yeah, a whole alphabet soup of them. They opened lending facilities directly to primary dealers, the big investment banks, supported the commercial paper market, vital for short-term business funding, helped stabilize money market funds, which were seeing runs.
What was TALF?
Term Asset-Backed Securities Loan Facility. That was a joint Fed Treasury effort to restart the market for securities backed by things like car loans, student loans, credit card debt, trying to get credit flowing to consumers and businesses again.
And steps to boost confidence.
Right. The Fed publicly committed to supporting mutual funds. The Treasury temporarily guaranteed assets in money market funds. And the FDIC, the bank deposit insurer, raised the insurance limit from $100,000 up to $250,000 per depositor. All aimed at stopping bank runs and reassuring people the system wouldn't totally collapse.
These actions were constantly called unprecedented, but Section 3.2 uses an NBER paper to ask, were they really, from a historical view?
That's a fascinating question. The paper argues that while the scale and some specifics felt new, the idea of central banks taking extraordinary discretionary actions in a crisis actually has a long history.
So not totally out of the blue.
Not entirely. The debate often goes back to Walter Bagehot's rule from the 1800s. In a panic, lend freely but charge high interest rates and demand good collateral. That's a strict instrument rule, partly meant to discourage banks from relying on bailouts, limit moral hazard.
Right.
But history shows central banks haven't always stuck rigidly to that. They've sometimes used more flexible target rules, where the goal is, say, preventing collapse, even if it means bending Bagehot's conditions. Discretion isn't new.
Can you give examples?
Sure. The Bank of England in 1866 largely followed Bagehot but needed government permission just to print more money. The Banque de France in 1889 acted more preemptively, organizing a rescue before full panic hit, lending on iffy assets, but importantly, they imposed harsh penalties on those responsible to try and counter moral hazard.
Okay, so intervention but with accountability.
Exactly. Even in the U.S. panic of 1907, before the Fed existed, the New York financial community, including proto-Fed actions, intervened lending at low rates, deviating from Bagehot to stop the panic. France helped out then, too.
And the flip side, what happens when central banks don't act decisively?
That's the other crucial historical lesson. The NBER paper strongly argues that the Fed's relative inaction during the bank panics of 1930-1933, its reluctance to take unprecedented steps then, made the Great Depression far worse. The policy responses back then came more from Congress and the White House, not forceful Fed intervention in the markets.
So inaction can be catastrophic, but intervention carries that risk of moral hazard.
Precisely, and this is the core tension the paper highlights looking back. It argues that recent history before 2008 actually tilted towards creating moral hazard. The 1984 bailout of Continental Illinois Bank essentially created too big to fail by protecting all creditors, sending a signal that big institutions would be saved.
Setting a precedent.
Yes, and the Fed-orchestrated rescue of the hedge fund LTCM in 1998 reinforced this, contributing to the idea of the Greenspan put, this market belief that the Fed would always step in to cushion major losses from risky bets.
So the argument is, these earlier rescues, maybe by not having enough penalties or consequences, actually encouraged the excessive risk-taking that fueled the 2008 crisis itself.
That's exactly the argument. While rigid inaction like the 1930s is disastrous, intervention without strong measures to curb the resulting moral hazard, like in 84 or 98, just sets the stage for the next possibly bigger crisis. It reframes 2008 not as totally unprecedented, but as the result of this long-running, unresolved tension.
Which makes the response after 2008, the regulatory response, even more critical. That led to the Dodd-Frank Act in 2010. What was that all about?
Dodd-Frank was the big legislative answer. A huge, sprawling law aimed at fixing the perceived flaws exposed by the crisis, making the system safer, more transparent.
What were some key pieces? Consumers got a new watchdog.
Right. Yes, the Consumer Financial Protection Bureau, the CFPB, created specifically to protect consumers dealing with mortgages, credit cards, student loans, etc., trying to prevent those predatory practices we saw.
And tackling too big to fail.
A major goal. Dodd-Frank set up a process called Orderly Liquidation Authority. Basically, a way to dismantle a huge, failing financial firm without causing systemic collapse, and importantly, funded by assessments on the industry, not taxpayer bailouts.
In theory.
In theory. It also slapped much tougher capital and leverage requirements on big banks, forcing them to hold more of their own money as a buffer. And it tried to rein in the Fed's emergency lending, requiring Treasury approval and good collateral, and prohibiting bailouts of single firms.
What about preventing crises from starting? An early warning system.
Yep, it created the Financial Stability Oversight Council, FSOC, bringing together different regulators to monitor the system as a whole, identify emerging risks from big firms or activities that could threaten stability.
And shining a light on those complex derivatives.
Big focus there. Tried to close loopholes that kept the OTC derivatives market in the dark. Pushed more trading onto exchanges and through central clearinghouses to increase transparency and reduce the risk of one firm's failure dragging down others. Hedge funds also had to register with the SEC and provide more data. Mortgage brokers, payday lenders brought under more federal oversight, too.
Anything else major? Corporate governance.
Yeah.
Investors.
Yeah, shareholders got a non-binding vote on executive pay, say on pay. New rules for credit rating agencies to improve accuracy and handle conflicts. Stronger enforcement tools for regulators. More protections for borrowers taking out high-cost mortgages. And even new incentives and protections for whistleblowers reporting fraud.
So a really comprehensive attempt to rewire the system. Looking back now, Section 4 tries to distill the enduring lessons. What did the official investigations like the SCIC ultimately conclude were the root causes?
Section 4.1 sums them up. Their findings really hammer home the points we've been discussing. Top of the list. Widespread failures in financial regulation and supervision. Regulators, including the Fed, failed to stop the flood of toxic mortgages or address the building risks.
And failures within the firms themselves.
Absolutely. Dramatic failures in corporate governance and risk management. They found recklessness, excessive risk-taking, poor internal controls, just fundamental mismanagement.
What about households and policymakers?
The report cited excessive borrowing and risky investments by households too, alongside a lack of transparency across the board. And they found policymakers were often ill-prepared, didn't fully grasp the complex system they were dealing with, and responded inconsistently.
Sounds like blame to go all around.
Pretty much. The Financial Crisis Inquiry Commission was blunt, talking about a systemic breakdown in accountability and ethics at all levels. They highlighted the collapsing lending standards, the securitization pipeline, pushing bad loans, deregulation of derivatives, the rating agency failures, risky products, hidden conflicts of interest. They were clear. This wasn't fate. It was the result of human choices and failures.
And that brings us back again in section 4.2 to that persistent problem. Moral hazard.
It really is the recurring theme, isn't it? The historical examples, the interventions in '08, they all raise the same question. How do you rescue the system in a crisis without implicitly promising future rescues? That promise, that put, encourages risky behavior because the potential costs seem lower if you expect a bailout. It's the central dilemma. Did the 2008 rescues, necessary as they might have seemed, reinforce that moral hazard? The debate continues.
Okay, let's pivot from the system to the individual. What are the takeaways for you, our listener, as an investor? Section 4.3 draws some lessons.
One big one, don't try to time the market. Seriously. 2008 showed just how fast markets can fall and how impossible it is to predict the bottom or the top. People who panic sell often miss the best recovery days.
So what's the alternative?
Invest based on your goals, retirement, education, whatever, and manage risk through diversification. Don't put all your eggs in one basket. Rebalance regularly to stick to your plan. Focus on the long term, not the daily headlines.
Makes sense. What else?
Give time to your investments, meaning do your homework. Understand what you're investing in. Don't just chase hype. Read, analyze, stay aware of things relevant to your holdings. Take ownership.
And the idea that if you just avoid stocks, you avoid risk.
That's a myth. 2008 helped bust. Risk is everywhere. Staying out of stocks means you face inflation risk, your cash loses value. Interest rate risk, the risk of just not growing your money enough to meet your goals. And 2008 itself started in housing and credit, remember, not just stocks. Financial risk is woven into the whole economy. You can't avoid it. You have to understand and manage it.
Good points. And finally, Section 4.4 revisits some broader economic lessons.
Yeah, the crisis was a stark reminder of global interconnectedness. Trouble in U.S. mortgages didn't stay in the U.S. Toxic assets, derivatives, trade links, it spread everywhere fast.
And the importance of regulation and its limits.
Exactly. We saw the critical need for strong regulation, but also the danger when risk moves into the shadows outside the regulator's reach, like the shadow banks, the off-balance sheet stuff. Regulation needs to be smart and comprehensive.
Leverage keeps coming up, too.
Always. For banks, for homeowners, too much leverage creates fragility. It boosts gains but makes downturns potentially catastrophic. Understanding and managing leverage is key at every level.
And the lesson on policy response.
Flexibility and forcefulness seem necessary, and a crisis in action can be worse. But as that MBER paper argued, it's crucial to pair intervention with measures to mitigate moral hazard. Make sure the system doesn't encourage a repeat performance, and ensure accountability. Ultimately, the crisis showed that while economic cycles happen, it's the structural flaws, the policy choices, the human behaviors that can turn a downturn into a full-blown disaster.
So, wrapping up,
Yeah.
2008 wasn't just bad luck. It stemmed from that perfect storm. A housing bubble fueled by easy money and unrealistic expectations, enabled by lax lending, amplified by leverage, packaged into complex, opaque securities like MBS and CDOs, often hidden in the shadow banking system, all within a context of regulatory gaps, questionable ethics, and misaligned incentives.
The response was equally huge. Massive government interventions, TARP, QE, and then Dodd-Frank, trying to fix the underlying problems and protect consumers.
But that historical perspective reminds us of the ongoing challenge.
Yeah.
How do you intervene without creating moral hazard, without encouraging the very behavior that caused the problem?
And for you, the listener, the takeaways are clear. Understand leverage. Don't try to time the market. Focus on informed, long-term investing tied to your goals, and recognize that risk comes in many forms.
So here's a final thought. Building on those investigation findings about ethics and accountability and the history of moral hazard, how much have the fundamental incentives and behaviors that drove 2008 really changed? What's your role as an informed citizen and market participant in spotting and maybe even mitigating the risks that could cause the next crisis?
Definitely something worth pondering.